Today's guest has done two pretty remarkable things. Pete Flint has not only founded Trulia, one of the most successful prop tech companies ever, which he sold to Zillow for $3.5 billion in 2015, but he has also, two, founded NFX, the world's largest dedicated seed fund. On this episode, we'll cover the ups and downs of founding Trulia and also why he left operating to become a venture capitalist. So let's dive in. Pete, welcome to the program. Great to have you here.
Thanks, Rex. Very good to be here.
So I want to start things all the way back at the beginning for what kicked off your entrepreneurial journey for what became Trulia, although that was not actually your first startup. But let's maybe start there about what led you to come to the U.S. in 2003.
Yeah, so I is a detect from the accent. I was born in the UK, I guess I got while I was at undergrad, I got fascinated by the internet. I did like a bunch of internships at different places, and then on graduation, I ended up trying to get into internet startups. In '96, I was okay. I want to do an internet startup, and I've been reading about it, and I wrote to all the internet startups. I think there were 17 internet startups.
What was the most exciting one you remember? Most exciting internet UK startup, late '90s?
I mean, they were all sort of like trying to be AOL-esque. So there was connectivity and media. And I think it was the momentum of the industry, the opportunity to democratize information. I mean, as a 20-year-old, I was like, wow, this is a rocket ship. And so I just wanted to be on that rocket ship. And I had had some summer jobs at like JP Morgan and IBM. And I just I really didn't like that kind of like big corporate world.
That really didn't, give you a lot of energy getting up in the morning trying to go into a big bank or a big tech company?
Iron my shirt, put a tie. I mean, those are the days where you did that stuff. Crazy now. So I was just like, okay, I really don't. I know, and it's great because I sort of A/B tested my career in some ways because I tried these things with sort of no regret losses. I said, okay, this internet thing is incredibly exciting. I want to do that. So I wrote to all of them and said, you ever need summer jobs? And most of them just didn't have any money, so they couldn't pay me anything. And I was sort of a poor student. So I ended up joining for the summer this company called Line One, which was a joint venture between British Telecom and News Corp. Connectivity and media, really interesting group of people. And then I sat next to a guy called Brent Hoberman, who later on became the CEO and co-founder of Lastminute.com.
Lastminute.com being a verticalized search marketplace for travel and leisure.
Yeah, exactly. Yeah, no, it was. I mean, So I joined them after graduation, really as the sort of first employee, one of the founding team members. And it was an epic .com journey. It was like we launched in the summer of 1998. I was doing what you'd call today like growth. I was like head of growth and BD and product and everything else. And then we went public 18 months later. 18 months after launch, we went public. And that was March 2000. And then the kind of .com collapsed. And then travel collapsed on top of that in September the 11th. But we grew over that period from 0 to 2,000 people. So I left in 2003.
Wow.
I was just in the eye of the storm and kind of front row seat at really the craziness in London and travel and .com and marketplaces. So that was just an epic experience.
So you got to ride the boom and then a little bit of the bust. And then in 2003, you decide to come to the US. And I think some of the folks out here in the Bay Area were a little disillusioned with the internet, thinking, oh, it's over.
When you're in London, you're like, you want to be in Silicon Valley. I mean, at least I did in 2003.
I keep reminding founders of this in 2023 because I think it's still generally relevant.
Yeah, absolutely. You could still see, sure, that sort of, the population was questioning the importance of the internet in 2002, but we looked at all the metrics outside of the stock prices and the momentum, the scale, everything was growing at a breakneck speed. And so my path to Silicon Valley was via an MBA. And then, in the summer of 2004, started to think about what's next.
You're doing business school in the Valley at Stanford's GSB, which is where you also met your co-founder as well.
Yeah, exactly. I mean, it's like there's a reason why companies are created there, because every day you meet founders that are either presenting or you're in your class. There's capital, there's culture around kind of like creativity, destruction, innovation. It's such a fertile soil. The Stanford MBA is not a training ground for McKinsey or Goldman. It's really a training ground for startups.
So how did you use that training ground to actually incubate an idea, and how did you end up deciding to start a verticalized search marketplace for real estate?
There were a couple of different sort of things that combine. I guess really two things. One was that the way that these classes work is that the first year they put you on campus housing, and the second year they said, okay, you're on your own. You got to find. So teamed up with a bunch of friends. We said, let's get a house together, and then said, okay, here we are. This is Silicon Valley. This is the most advanced place in the world. How do we find information about houses to rent or houses to buy? I'm trying to think through what would be the right thing to do in our collective financial situation. So in the most advanced place in the world, I was told I'd had to go and speak to either a real estate agent or go on Craigslist, which for what is either, if I'm renting, it's the biggest outgoing of on my kind of monthly expenditure, or if I'm buying somewhere, that's probably the single biggest financial decision of my life. So where's the information? Where's the consumer tool?
Right next to a listing to buy a used couch, it turns out.
Or the newspaper where everything's out of date. So I was just like,
Yeah.
okay, this is kind of nuts. You could see that it was like, okay, this is the right timing for this sort of activity. And then I really benefited from that time in online travel, where you have very clear consumer demand. You've got fragmented suppliers that don't really know how to navigate the internet. And so how do you construct a consumer experience that gives consumers what they want, and then also gives the market participants what they want? And so that was the primary catalyst. I also spent a summer at Battery Ventures, helping them out on sort of diligencing stuff, and that kind of gave me sort of more confidence that this is going to be the idea. And I said, at the end of the summer, and then I said to them very clearly, I don't know whether you want to give me a job when I graduate next year, but regardless, I don't want the job. I want you to fund this startup.
So really kind of a confluence of three things there. One, your experience in building verticalized search at Lastminute. Two, search is just ascendant at the moment. Google's just done an IPO in 2004, very well received. And three, conducting your own personal search for a place to live and realizing it's pretty broken.
I came back from, back to school, and the first person I wanted to chat to about this was a friend of mine, a classmate called Sami Inkanen. And he was committed to being an entrepreneur, just like me. He was similarly excited about it. And so we teamed up and worked on class projects and spent, half of our student time working on what became Trulia, and then half of it just getting by with studies. But it was one of those things that we had confidence that this needed to happen. And also felt that we had the skills to actually make it happen.
Yeah. In the 20 years since the dot-com boom and then burst, we've learned a lot about what it takes to build network effects-driven businesses, to build marketplaces. But at the time, it's not necessarily as codified as it is right now, although it's still hard. Probably one of the big first issues you face is the cold start problem. How do you actually get this marketplace started for Trulia? So how did you work to break through the cold start problem at Trulia?
Yeah, so we had a really, I think a very challenging problem, because consumers wanted to see everything in the market. And then on the broker's side and the agent side, they wanted to distribute to places as long as you had consumers. And there's sort of two ways to do it. One is that you become what Redfin did, is an online real estate brokerage, and you have to sign up for a bunch of rules and restrictions. You have your own agents. You sort of become a, what we think and is sort of proven out is a lower margin, operationally intensive real estate brokerage. Or you try to build a kind of like, an asset light marketplace, which was what, Trulia decided to do. And Zillow, as it turned out, had the similar kind of vision 6 months after us. And so, the way that we solve the cold start problem is really twofold. One is the majority of consumers online used online search engines to search for real estate information because there was no brand.
And there's this point in time where we talked about Google had just gone public. Consumers are using search.
Yeah.
But search hasn't been optimized by 1,000 companies for SEO. So you have this greenfield opportunity to own the SEO category.
I just seen in my kind of previous experiences, like, jumping on these high growth platforms. So what is the symbiotic relationship you can have with a platform? You have a fast growing platform and Google needed content. And actually the way that the brokerage sites were architected was that they actually were restricted by the National Association of Realtors, if you're a brokerage, to expose your content to Google. And so there was a very specific opening for us to dominate essentially in SEO. And that window was wide open, and we were kind of like analytical, product-minded folks that could figure that out. And then the other benefit of that was that the supply side acquisition, the inventory was, we built a bunch of like APIs and interfaces, but also built a search engine that would enable, some random broker with a bunch of listings on his website to publish those automatically without any friction. We kind of did it in many cases, asked their permission, but also said, hey, look, you're going to get everything for free back anyway. If you don't like it, you can stop. But it just took time to build up that inventory. So over the next couple of years, we kind of built up this sort of like slightly primitive scraping and indexing and feed system with this rapidly growing consumer audience. But the net result, we spent zero on marketing. So over the next kind of couple of years, there was like, we reached millions of monthly users and iterated on a great product experience. The other thing that we did was at the time was like, real estate prior to then had been sort of a one-dimensional experience. No one did integrate maps meaningfully into the experience because it was too expensive. Mm-hmm. And we launched 1 month after Google Maps came out. And so we, our engineer essentially sort of hacked the Google Maps experience before they opened up the API. And then we opened up the API, we signed up. So we jumped on these kind of trends and we said, okay, Google Maps, that's a breakthrough product feature over the whole experience. And we integrated that. And so we immediately, at launch, we had a whole bunch of data and a visual experience, which was superior to anything else that was out there.
So you're starting to scale the supply. 2007, to quote you, you're crushing it. Things are going really well. So what does that look like? What do you attribute that to? What are some of the metrics you're tracking that are driving that success?
By 2007, so I guess we raised a kind of small, what you'd call seed round while we were at school. And then we raised a Series A led by Index, which was like 6.7 million. And then a Series B in 2007 led by Sequoia, which was 10 million. So at that point, we'd raised a bit under 20 million. And, audience was growing 10x year over year. There's light monetization. We're 50 people. I don't remember the audience numbers, but sort of in the kind of probably 1 million monthly users, that kind of range, with zero marketing. So it was happening.
And then what happens next after that kind of period of growth? 2007, certain things start percolating through the real estate ecosystem.
So in 2008, the market, we know what happened in sort of Q3 2008 and Q4 2008. As folks know, the global financial crisis was precipitated by the mortgage industry and dodgy mortgages. And so what we'd actually seen kind of on the inside, we'd seen prices and transactions peak somewhere around the end of 2005, 2006. So during that period, we'd been actually growing rapidly in a declining market. And, that was okay because we were at very small market share. But we kind of were we were already, even though the market was somewhat frothy at the time, the real estate market was incredibly lean because there was already a real estate recession at that point. And then what happened, in the summer of 2008 was that the whole market collapsed. So kind of, not dissimilar to what's happened in the last couple of years or last 18 months in tech, is we saw a massive pullback in demand for our product. And we saw a massive evaporation of capital that was investing. And I think we were literally felt like the eye of the storm because real estate prices and transactions were down both by about 30%. Real estate companies were going bankrupt. And online real estate just seems like the worst place to be because tech took a beating as well.
Your primary monetization comes from large enterprises who are paying you at this point. Is that right? So you're also losing your biggest customers.
So we had all these big clients and they were, they had to do their own cost cutting and they sort of immediately canceled the contracts. And so that was just brutal in terms of just treading water, losing revenue. The unexpected upside of that, though, was that, as I said earlier, we had this sort of quite janky aggregation of listings. We went back to all the big brokers and said, look, we know you're hurting. You have way too much inventory that's not being sold. Why don't you give us this real-time data feed of all your properties, all the photos, everything, and we'll promote it on our website for free. And then you can go and tell all your agents, you're doing this great thing for you. It's not costing you anything, but we're going to give you access to, millions of consumers at that time for free. And so while it was a horrible time in the industry, we were able to basically flip the supply side. They were going to promote Trulia to all the agents and then promote all the properties on Trulia, which consequently promoted Trulia to millions of consumers.
So you now have this massive distributed promotional network of agents that's unlocked to some extent by making it free and pushing out these tools through some of your previously paid customers.
In retrospect, it was great. The data was sort of previously incredibly hard to unlock. It's fragmented across MLSs, lots of different rules and restrictions. And so because we were a white knight during that period, we could open up all that inventory.
For you, terrible time, really hard, but to be able to pull forward getting reliable access to that data is a big unlock for the business.
In retrospect, I think in 2000, in 2001, 9/11, online travel, we were good at Lastminute, but we were still a little bit deer in headlights because we were like, this is so uncharted territory. And, I think having kind of gone through this sort of crisis navigation at Lastminute gave me okay, either the economy is going to collapse, which felt like a real possibility at the time, or we're going to get through this and things are going to be fine. And they're going to be using all these tools more in the future than ever before. And so if you look back in online travel, it's Expedia and Lastminute and Booking just dominated kind of post 9/11, and the market share gains were massive and literally, sustained 20 years later. And then I think the same thing happened in online real estate. Trulia and Zillow aggressively were kind of, both teams had come out of online travel. We're okay, this is this feels terrible, but let's lean into it and like use this while everyone else is distracted and take market share. And that's what both companies did.
Yep. I also want to flip and talk a little bit about culture, because one of your most important assets as a company are the people that are working for you. So during this time, you're a company about 50 people. You talked before about how you think about building culture differently at Trulia, and making sure that people don't leave when things get really hard is critical to survival. So what were the foundational pillars you laid for Trulia's culture?
Sort of go back to the origins of the company when Sammy and I were at business school. You know, we we went through this sort of like, it's now called Startup Garage, but there were like various different modules, like, you know, thinking about your kind of go to market, thinking about your product, blah blah blah. And it sort of feels a bit academic at the time, but there's one specific kind of thing to just like, okay, how you're going to think about your talent and culture as an organization. And we thought very hard about that in terms of just what kind of culture we wanted to create, because we knew that we were going to, whatever we were going to do, we're going to spend like 80 plus hours and really maybe working 5 to 10 years in this thing. It's like, if we don't like the culture, then we're not going to be motivated, and we're certainly not going to be able to hire anyone. So like the culture is like incredibly important, and trying to find out what is the culture that you want to work in, also with the culture that is aligned with success in this type of business, um, aligned with something that stands out and that's remarkable. So we thought really hard about it. We sort of codified it, as all the companies do, and these days, and just, okay, these are our sets of values. And then what we did literally since inception was that we tracked how our employees felt that we were delivering on these values. Like a product manager would track NPS. You know, and so many companies just like create these values, put them up on the wall, put them in the employee handbook or intranet, and then forget about them. It's like, you know, okay, if we're underperforming in one metric, okay, what are we going to do as an organization to improve that? And so we'd really tried to be true to these values and kind of improve them over time. And it sort of, it felt important, but it wasn't really until this 2008 period that it was that we really tested it.
Everyone's happy when you're growing 10x year over
Yeah,
year.
exactly.
There's more opportunity, responsibility.
Exactly. It's like things were going awesome, and then like, okay, the sort of proverbial shit hits the fan, and the Leman moment, and like housing is in the toilets. Like, okay, and we're running out of cash, and there's literally no one is going to fund a business like that. We needed to figure it out, and so that was that. Alongside, I think, just from my perspective, I think I had there was a little bit of an oh shit moment myself. It's like, I don't know how to do this. I don't know how to get us out of this. And rather than trying to be the sort of like, this is the plan, the sort of, you know, this is what we're going to do. It's like more like, this is the problem. This is where we need to get to, and breaking down this problem into various different teams. I said, well, if you improve our, you know, customer acquisition, and if you improve our monetization, if you improve this, break it down teams, like, we're going to get there. So chart out what we needed to do, but I had no idea how we would do that on an individual kind of project by project basis. And then being frank with the team, this is what we need to do. You guys go and figure out how we do it. That was like a massive unlock.
Yeah. And so you built this cultural foundation prior to the Great Recession, but then during the Great Recession, you're on top of that cultural foundation, you're having to shift how the org is actually structured. I think you framed it as maybe moving from more of a command and control to a slingshot organization.
When you're an early stage startup, you're doing something that the idea has never been done before. It's sort of by definition contrarian. It's like, this is sort of seemingly impossible. And to move fast, you don't really, if you're a small team, you don't sort of design by committee or distributed decision making. You say, this is what we're going to do. This is a massive opportunity. The founders have a sort of different point of view. Let's going to go and execute and scale. And that worked great for the first couple of years. But I think as we sort of reached this sort of 50 plus number, things sort of started to fall down because it was impossible for this sort of command and control structure to scale. And so we really shifted from this, more micromanagey approach, I would say, to like, okay, we're gonna set you what you need to do, but you need to figure out how you go and do it. And if you hire exceptional people and give them, resources and a great culture, then they're going to figure it out within this sort of like, okay, this is the set thing you need to do. This was not a GM type structure. There was a kind of mini GM that was sort of some person. It was like, okay, this is small teams, what's it, pizza-sized teams, 2 pizza-sized teams that would just go, okay, you're working on this, you're working on this, you're working on this. You figure it out. And that enabled us to move really fast to get the best out of people and figure out how we got through this.
Yep. And yeah. So through the recession, changing the go-to-market from being very enterprise-driven to more agent-driven.
Yeah, this was the other thing that we did. So we changed the business model. So we went from these sort of like enterprise customers where we had, half a dozen, quite expensive.
Paying $500,000 or more a year to you.
Yeah, maybe. Yeah, they would be bringing in kind of revenue sort of $500,000 to $1 million a year. That wasn't working because they didn't see a clear ROI. We shifted to basically a SMB SaaS model where we would get agents spending a couple of $100 a month at scale, and totally shifting it from small number of customers paying a large amount to a large number of customers paying a modest amount, which was at the time was incredibly scary. But as it turned out, worked great. Because it was like, it didn't come down to like whether we'd get whether we'd hit the quarter, depending on the quality of the baseball tickets we bought. The main buyer, it would be like down to metrics and down to retention and kind of acquisition and training and all that sort of stuff, which was much more controllable and scalable.
Yeah. So you were founded in 2004, but you're really built during a recession. That's when you defined your business model, you defined your organizational structure, you cemented the network effects of the business by securing the data access. And then you were also forced into being highly capital efficient. A good lesson for maybe some of the startups of yesteryear or even the present moment to reflect on. You'd raised about $33 million total before becoming cash flow positive and then going public. After you've re-architected the business during the recession, what does the path towards the IPO in 2012 look like?
Yeah, so we got cash flow positive. I forget exactly, but I think kind of like 2009, 2010, and then we were doubling year over year. And we tried to go and raise money, but no one would give us an up round. And I think it's going to be a common situation right now. It's like no one's giving you an up round.
Yeah, a lot of startup founders, they've tested the market. No one's giving them an up round, so let's get cash flow positive.
Get cash flow positive and let's figure it out, and then reinvest all our revenue and profits back into growth. And we'd sort of been like these sort of like African marathon runners that are training at altitude. It's like we've been sort of really efficient in everything we've done. And so this was 2011. It's like, okay, things were going really well, and the IPO market started opening up. And what had happened was because we'll see this kind of pan out in the US over the next couple of years, that there was a huge amount of capital sitting on the sidelines ready to invest in high quality public stocks. They were burnt by some of the later stage private investments, and we're just like, let's just kind of like let's sit on the sidelines. So we started to see like companies going public. One of our main competitors at the time, Zillow, went public about a year before us and had a great IPO. Facebook went public 6 months before us, and after a rocky start, still had a great IPO. And so we'd seen these like, okay, the IPO market started to be wide open, tons of cash ready to invest.
And we might be in a very similar place right now. You have a lot of businesses that have raised too much, that have driven low quality revenue. Now they're being forced to grow while being leaner, having higher quality business models. And it seems like there's no light at the end of the tunnel. But the reality is, if you figure out how to get through this period, people are going to recognize that.
Yeah, it's for sure. The kind of, I don't know when the IPO market will open up, but I think, the Open Table was probably one of the first that, went out in a small IPO. And I'll expect to see the IPO companies that will be targeting the IPO to IPO in 24. And then after a string of success, you'll start to kind of like, it'll fully open up. And so, essentially we were able to get, what we felt was probably double the valuation in the public markets and the private markets. Just because there was like the late stage capital would just dried up after the recession. And so we're like, okay, this is it. So we went public in 2012, and modest IPO, sort of market cap was 500 million. But it was, great for us to, 7 years in, to get kind of visibility, have some currency for scaling, and get, some liquidity for some of the investors as well. So that was 2012. And I think by that time, it really became obvious about the resilience of the network effects that we built. We built this supply, we built this demand, we built this matching. And it was like, this is a super resilient business that was really capital efficient. And it opened my eyes just up to, the power of network effects. That once these things get established, there's no going back.
And so you go public, you've been capital efficient, 33 million raised to get to cash flow positive and have a well-received IPO. You had a 41% pop on the first day. Not that that matters, but just to say the climate for receptivity for IPOs was strong at the time. But you're now also starting to reach scale and battle head-to-head with Zillow. You're both spending, at one point, $150 million a year on trying to market and grow your businesses. What's the general climate and your general kind of headspace as you're going head-to-head with Zillow, trying to battle it out to become the number one in this category?
We started at a similar time. I think they launched about 6 months after us. They'd raised at least 3 times the capital that we'd raised. And they, that capital advantage had sort of given them a quarter or two ahead of us. So we were both growing like this. They were just a little bit bigger than us, which was like maddening. And then during the period of time, the features that they had, our customers also wanted, so we added them. And then the features that they didn't have that we had, they added them. And so the product experiences were, on a feature level, basically become identical. And we do consumer surveys like, why do you like Zillow more than Trulia? It's like, well, I like blue. I like that kind of color. I like the interface, And then we'd ask Trulia users, why do you Trulia over Zillow? And they're like, well, I like green. And I like the interface. It's better. So there's really very limited kind of product differentiation at that point. And so both companies were putting, significant amounts of money into advertising on TV and Google and everything else, and just is kind of aggressive, enormous respect for folks, but it was sort of, okay, this wasn't clear how we overtook them, and we were kind of internally just like, well, what's the path there, particularly when you're in a public company situation where you've got pretty clear kind of guidance expectations about the future of the company, and deviating from the plan A is going to be like pretty dramatic in terms of the impact on the stock.
And this kind of culminates in 2015 when you get an email from the CEO of Zillow that derails your 40th birthday plans.
So kind of Zillow and Trulia, we'd had a couple of like serious dates over the years, because we were the most similar. So we kind of had some sort of conversations about how do we combine businesses, and they it didn't come to anything, for a number of different reasons. One in particular is just that it's very hard to agree on what is the right price, or in this case, the exchange ratio between like of the combined entity, how much would each shareholders get. Both we did that private, public, and then it's easier public because there's just pretty clear data around that. And then I got an email from Rich Barton, who's a founder and chairman, saying, Pete, are you free for dinner next week? I replied back saying, no, I'm really busy, because I wanted my closest competitor to be thinking that I'm going to be like never eating, never going out for dinner, 18 hours in the office, maniacal. And he sort of just started to be very insistent. And then he said, look, Pete, I've got this letter here signed by my board of directors that I'm going to send to your board of directors proposing a merger. So I really think we should meet up. And then I said, oh, Rich, I would love to, but it's my 40th birthday next week, and my wife's organized a party with family and friends in London. And I was on the way to the airport at the time, so it was just like he'd sort of given up on email and called me. So anyway, I did go to London, did have my 40th birthday, did spend most of it on the telephone with lawyers and bankers, and then we announced I came back, and then we announced the merger about 6 weeks after that first conversation.
And what was the framework you used to decide that it was the right time to sell?
We didn't need to sell. Clearly, the transaction price was, 3.5 billion or 2.5, depending on kind of when you count it. And we were profitable, growing quickly. So we were in a good position. But the framework that I used was really like, was the following. So one is like, have the rules of the game changed? Have the things that have helped you to be successful in the past going to be helpful for you to be successful in the future? And the thing that had been helpful for us in the past had been product. We'd scale audience, we scaled supply, we scaled revenue, really, and all PLG, all organic, incredibly efficient machine. And we'd reached a scale where it was, product parity. It was all kind of essentially all marketing at that point. And while we had a efficient machine, it's like it was no longer a product battle, because there's limited differentiation because of products. Two is like, is someone going to pay current value for future execution? And we're a public company. 3.5 billion. I felt like for a company doing, $250 million run rate revenue, felt like a kind of like a fair price for future execution.
Today, companies are trading at 3.6 revenue across fintech as a rough frame of reference.
Things were growing well, but it's like, it was like a fair price. 3 was, are you number one in the category? And we were number 2 in terms of scale. And, while I felt we had a better product and better team and all the rest of it, it's just like we just couldn't kind of like grow fast enough to overtake. And when you're not number one in a category, it just becomes very, very hard.
Especially in a network effects driven business.
And then 4 is like, was there a sort of fatigue or kind of like exhaustion? And I didn't feel that. I was hungry for it, but the other 3 were definitely true. And it was definitely sort of humbling, at best job of my life, epic experience. Achieved everything that I wanted to achieve, other than acquiring Zillow. That would have been the kind of preferred outcome. um, but and they're really good guys, and so it felt like the combination made a tons of sense. And when you're a public company, you don't always make these kind of choices as well. But it was like, regardless of that, it felt like the right choice at the time, and so we combined forces in 2015.
So in 2015, you've now exited out of Trulia, but you're not done. You then go on to found NFX, which is the largest dedicated seed venture capital firm in the world. So Fund 3, $450 million, dedicated to pre-seed and seed across industry. Yes, you do fintech and some real estate, but you really do a bunch of other things as well. Would love to hear why you decided to move from being a founder and an operator to a venture capitalist.
Yeah, well, so I took a year off after the merger, and just do what kind of most folks would do, is just started to give advice, advising friends and people that would reach out, and angel investing more. I didn't do a lot of angel investing while I was running Trulia, for reasons. I think it just set the wrong example to employees. It's like we were in a kind of like do or die situation, and having an angel investment portfolio just felt like a side hustle, and I wouldn't like it if my boss had a side hustle. So anyway, I think I don't think founders should be doing that, not at scale anyway. So I kind of did a lot more angel investing, and just found I really enjoyed it, but I didn't like the lack of team and kind of leverage. I guess I prefer to just solve interesting problems with teams, and then I had a few opportunities with the sort of usual Sandhill folks, but had been a founder, I guess, for too long, that I didn't want to kind of slot into someone else's culture and organization, and kind of felt the opportunity to create something new. So I teamed up with James Courier and Gigi Levi-Weiss, who I'd known for a number of years, and they were just starting this an accelerator at the time, with Stan Chudnovsky, who spent many years at Facebook Meta. And then after, we spent a lot of time together, and then I decided to join, and to turn it into an institutional seed fund. And so that really just a shared interest in a number of different things. One is like NFX, everyone knows network effects. And so that's the story of my career, and that's the passion for James and Gigi as well. Two is just being at the earliest stage. I can do, done IPOs twice, but just that early product formation is just the most fun, and kind of felt that, we as a team have a sort of unique superpower there.
And it's where I think you can deliver the most value the most quickly, especially when you have an expansive network.
For sure. But, interestingly, in at the time, and I still think today, is that most venture firms concentrate expertise and help at the later stages, where the money is. They will put expertise, help, and talent where they put capital. Whereas actually, we wanted to flip it and said, well, why don't we put the very best people like Gigi, James, myself, that have done, significant entrepreneurial activity at the various earliest stage. Unlike what everyone was doing at the time, and you put the junior folks at seed, and you put the kind of like experienced folks at the late stage. So that was really the kind of the approach in 2017. And then the last piece is really about how do we run a venture firm like a software company, because we're software entrepreneurs at heart. And so We have it's like 20 folks in our now it's a AI data and software team, which are building a combination of internal products but also external products. So we've been doing this for 6 years, where we've been okay. How do we we see what happens in Wall Street? How do we use technology to improve our investment decision making process? How do we unlock new ideas? How do we give tools to founders that help us to grow our awareness and brand? So those were the shared interests, and so we've scaled from our first fund 150 million to 450.
And for founders and operators who are thinking about starting something, they probably know by now because they're in fintech that if they're interested in building something in fintech, they should definitely reach out to NFX. But you guys are a generalist seed fund,
Yeah.
so I'd love to hear the areas outside of fintech that both you personally, but also the firm is pretty excited about.
We're generalists, so we like to think that we don't have the best ideas. The founders will have the best ideas, and so we're really looking for remarkable founders who have these unique insights. I guess the areas where I would say 80% of what we do fit into are in the following categories: so fintech and marketplaces and prop tech, gaming, and then also computational biology. So those are the areas we cover. That covers 80%, but there's always, a whole bunch of interesting other stuff, whether that's space, whether that is food, fits in a kind of like selection of other stuff. But with those are, those 5 sections are core. And then I think perhaps within where we are today is, we see a whole bunch of really interesting AI companies has permeated a lot we do. We've invested in something like 20 AI companies since inception for many years. One interesting one that's just announced a Series B led by Bessemer, where we did the seed, was EvenUp, which is a focus on the personal injury attorney space in the US, using AI to help that. We've done AI investments in which are sort of disrupting kind of renovation space, in customer outreach and inbound calls. The AI space is like undoubtedly incredibly interesting right now. I think where we've seen the success is where they have these quite specific vertical focused platforms often with some marketplace attached to them. Those are some super interesting companies that we've had. There's some combination of like, and this is not to get too buzzwordy, but it's like a sort of a vertical marketplace with a sticky SaaS component, with an AI experience that unlocks, some new product experience. Those are the companies that we've seen a lot of success over the last couple of years.
And maybe to bring that to light, give the example of EvenUp as a verticalized AI solution that to some extent has a marketplace attached. I'm actually not sure how much of a marketplace angle there is though on EvenUp.
Yeah, limited today, but it will scale. But it's, I think that what's really interesting is, we saw this category where it's a highly fragmented industry, and you see these billboards, which is, it's a kind of bizarre industry, but they're doing a real service. And the founders had one particular experience where a family member was injured in the workplace.
And to be clear, EvenUp helps generate demand lenders for personal injury lawyers. Is that?
They're essentially a tool to help personal injury attorneys do what they do better. That's way to think about it. And so if you're a personal injury attorney, you want to ultimately try to settle the claim with the other party, that could be an employer, an insurance company, for the most appropriate amount before it kind of gets dragged out into trial. And that's
as quickly as possible.
That's a kind of a big data problem. And the higher the amount, the more the attorney gets paid and the more the consumer benefits. And that these are sort of like performance-based fees that they can be really meaningful to these individuals that can often mean that they're unable to work again. And so if you're improving the experience for the end consumer while making the the attorney sort of see a good ROI on that spend, really it's transformational. So they've been working this problem for years, a really interesting team. And that's, it's fueled by data. So how can you use data to kind of improve that experience? And then the nature of the industry is that selling, this kind of product to the CIO of, I don't know, Oric or Perkins Coie or Wilson Sonsini is like, that's going to take a really freaking long time. Selling into lawyers, but selling into kind of individual folks that are often individual decision makers is much more straightforward.
Not unlike Trulia selling into real estate agents after pivoting from trying to sell directly into, a large agency like Coldwell Banker.
It's these kind of wedges that we really look into that are, okay, how do you, and the fragmentation as an asset for these businesses doesn't always feel like it. And then how do you really build this breakthrough product experience? And it's, I think people, you've seen these ways, these breakthrough product experience, whether it's driven by mobile or whether it's driven by Ajax and Web 2.0, it's like, and you can truly build these breakthrough product experiences with AI right now. And a lot of these marketplaces and a lot of fintechs are sitting on these gold mines of data. And so, the AI can really create through these breakthrough product experiences, which is such an exciting time.
Yeah, it's going to be very exciting to see how this tooling unlocks whole new sets of vertical solutions for industries that have been fragmented for a while and incumbents haven't been able to really serve. I'll ask you one last question we ask of all of the guests who come on, which is, what advice do you have for founders who are setting off to start something today?
Advice. Optimize for speed. This is like, I think as we look out, it's like the common characteristic is like speed of execution. And that's easy to say, but it's like, how do you sort of instrument your systems? How do you set expectations? And to be able to execute fast, you need to learn really fast as well. And so how are you kind of creating this really rapidly learning organization? And so just figuring out how you run really, really fast, optimizing for that gives you such a dramatic competitive advantage versus other folks and other incumbents who are just running slow.
Yep. Startups' biggest advantage over incumbents is speed. And so if you can move fast, especially when you have a massive platform shift, like all the tooling come out around AI, it's a big opportunity. Well, Pete, thanks so much for coming on. It's been an amazing conversation. I feel like especially relevant since there are so many founders out there right now who are having to learn how to change their businesses dramatically in the current funding environment, become incredibly capital efficient. So it's great to talk to someone who lived through a period like that in the Great Recession, then had a great outcome on the other end. And thanks too for sharing about NFX and what you guys are up to now.
My pleasure. Great to see you.
Thanks so much for joining. Hope you enjoyed this conversation with Trulia and NFX founder Pete Flint. If you'd like to listen to this in audio-only format, we also have a podcast, which you can be found on our website at CambrianHQ.com. And remember, if you like this content, please feel free to hit the like button or smash subscribe. Thanks so much, and I'll catch you next time.